Which investment has the higher after-tax return, stocks or real estate? I think you're going to be surprised by these numbers. The winner actually outperforms the other by more than double. Depending on the size of your investment, that could either mean thousands of dollars either made or left on the table. Keep watching till the end to see the smartest way to invest your money. Hi, I'm Nate. I'm a commercial real estate broker in Omaha, Nebraska. Today we're going to be looking at the after-tax returns of stocks, a Vanguard mutual fund, versus a commercial real estate property. Let's do it. For this scenario, we'll assume that an investor is investing $200,000 over a 5-year time period and is in the 22% federal income tax bracket and pays 15% on capital gains. Please note that state income taxes ranging from 3 to 13% in 43 out of the 50 states will be imposed on you. For today's example, we are just going to assume that you're in one of the 7 states that do not have a state income tax for simplicity. Let's jump on my computer and look at the numbers. All right, first we're going to look at stocks. We'll use a Vanguard mutual fund for this example. Now, as a reminder, we are assuming $200,000 is being invested over a 5-year time frame and is earning 8% interest. So what you're going to do is take 200,000 times 1.085 times to calculate your compounding growth. This is going to equal 293,866. So to calculate your profit, you need to subtract your initial investment of $200,000. So you profited $93,866, and then you have to subtract the tax, which for capital gains in this is 15%. 15% of 93,866 is 14,080, bringing your after-tax profit from a 5-year investment in a Vanguard mutual fund to $79,786. Next, we'll be looking at a $200,000 investment in a commercial property. Now for our commercial building. With $200,000 investment, you can more than likely purchase a building valued at $1 million because you'll be putting 20% down and you'll be financing the remaining 80% or $800,000. This is using leverage or other people's money, which has a lot of benefits that we're going to go over in the rest of this video. Other assumptions for this loan and example we're going to be working with is it's 8% cash on cash return the first year, and the rent of the tenant in this building is going to increase each year by 2%, which is a fair assumption. When you purchase the building, there's going to be 1% loan costs. We will be holding this building for 5 years, and then when you dispose of it or sell it for a higher price, and that's going to happen because the net operating income, also known as the rent, has increased over that 5-year time frame. You'll be selling it at the same cap rate that you originally purchased it at, but the closing costs for when you sell it will be 6%, which would be the commissions you would be paying the real estate broker for the transaction. The cap rate when you purchase this $1 million building is going to be a 7.5 cap, and we will also use that same number when you sell it at the end of 5 years, a 7.5 cap. And one of the best things about investing in real estate are the tax deductions you get to use. So the amount of income you're receiving, most of it is sheltered from the government and taxes. The 3 main things you get to deduct from your cash flow from the commercial property is interest. So you'll be borrowing money to purchase the building, and then you're getting the rent coming in, and part of that will be used to pay the mortgage or the note. The second thing is loan costs. You can amortize those over 5 years because in this example we are saying that you're owning the building for 5 years and then selling. And then the last one is depreciation, where for commercial buildings, you take the value or the price you paid of the building plus what it cost you to acquire it, and then you divide that by 39 years, and then you can deduct that each year from your income, so it lessens your tax exposure. The first and last years are a little bit less. We'll get into that when we go over the numbers, but it's just another thing that lessens the amount that you are taxed upon and makes investing in commercial real estate very favorable. So next I'm going to go over the year one items that you could deduct from your cash flow to calculate how much you'll be getting taxed, and then that same idea is going to be used on years 2 through 5. I'll go through that a little bit faster so you don't have to watch me writing a bunch of numbers down, but then I'll summarize everything at the end and we will calculate what the after-tax cash flow is. Now this is sort of a two-step process. First, we have to figure out what the taxable income is, and then we have to take that income, subtract the taxes from the cash flow to figure out the after-tax cash flow. I will write this down with you on year number 1, and then I'll probably speed up the video to go on years 2 through 5, but I'll walk us through here so we know exactly what we're looking at. So for year 1, the NOI is also the same thing as how much rent the tenant is paying us, because we are assuming this is a triple net lease. So when we purchase this at an 8 cap, the NOI ends up being $74,952. The interest that we will be paying each year as part of our note to the bank is going to be $43,617. And real quick here, so the main thing we're trying to figure out is the tax liability, how much we have to pay in taxes for this year, and then we will run that through for years 2 through 5 to figure out over the 5-year span what the after-tax profit is. Now depreciation, I had mentioned that for commercial buildings, it is the value of the building, what you paid for it, plus any acquisition costs divided by 39 years. Your first and last years of ownership are a little bit less because they're partial years. We can get into that in a different video, but the depreciation for this first year is going to be $19,885. The loan cost of the 1% of the price when we purchased it, we're going to amortize those over 5 years, so that is going to be $1,600. So when you take the NOI and you're going to subtract the interest, subtract depreciation, subtract loan costs, the taxable income for the first year is a whopping $9,850. Pretty good, right? And since this investor is in the 22% income tax bracket, the amount of taxes he's going to have to pay in year 1 are $2,167. Now I will go through and write this out for years 2, 3, 4, and 5 to figure out over the 5-year span what the after-tax profit is. All right, now that we've found the tax liability for each year, first year 2,167 and on, we are going to now figure out what the cash flow is after tax, and then add up all those years to figure out what the total is. So now for years 1, 2, 3, 4, and 5, we're going to take the NOI and we're going to subtract the annual debt service, and then that will bring us to the cash flow before taxes. You subtract the taxes, and then you get cash flow after taxes. So the NOI, remember, that is increasing 2% every year because of the rental increases. That is 74,952. Annual debt service each year, 58,952. So the cash flow before taxes is 16,000, which makes sense for your cash on cash return of 8% of $200,000, $16,000. And then when we look to see what our tax liability is for that first year, we're going to subtract the $2,167 cash flow after tax. Year one is $13,833. Now I will go through and fill in the rest of these. All right, that was a lot of numbers. Now we are going to add up each of the 5 years after-tax cash flow. So for the 5-year return on this $1 million investment property, the return is $79,628. Now, as you'll see, this compares fairly closely to the Vanguard Mutual Fund, which had a return of $79,786, but we're selling this after year 5. So this is a huge key on how commercial real estate is going to be a better investment over a 5-year time frame. Now I will walk you through the sale proceeds and how the value of the building increased along with the NOI, and selling at a 7.5 cap, and what that's going to mean for a return for the investor. Let's calculate the sales price, and as a refresher, the formula for cap rate is value of the building equals the NOI divided by the cap rate, or the rate. So when we purchased it, the NOI was 74,952. 74,952, and we purchased it at about a 7.5 cap, or 74952. That's how we came up with the $1 million price. Now if we're doing the same exit cap rate at the 7.4952, the value is going to increase because the NOI increased from 74,000 all the way up to 81,000. So now the new value of the building is going to be 81,130 divided by the same cap rate of 74952, and that is going to equal a sales price of approximately $1,104,000. Okay, now to determine the sale proceeds from this $1,104,000, we are going to subtract 6% for the broker sales commissions. 6% is about 66,240. That's right, sales commissions. The mortgage balance that you have to pay off, you've been paying on it for 5 years, but you have to pay that off. That is going to equal $714,172. So the sales proceeds before tax on the sale of this building after 5 years is $323,588. the taxes you're going to have to pay. There is a recapture on depreciation. I can go into this more in future videos, but it's a tax you have to pay because you did take the depreciation over the 5 years that you held the property. So your proceeds are going to get decreased by $22,423 for that recapture tax, and then the tax on the capital gain is $4,164, leaving with you the sale proceeds after tax of $297,001. We need to subtract your initial investment of $200,000, leaving the sale proceeds after tax at $97,001. Now we need to add the cash flows over the 5 years to this number. That is going to be the $79,628. And another thing I didn't mention, but it's called wealth accumulation or cash accumulation. If you would take the cash flows after tax each year, that's going to be these numbers, and invest them in, let's say, a 2% money market account. You can spend it, you can do whatever you want with it, but if you would invest this in a totally liquid money market account over the 5-year span, that is going to get you another $3,041 minus the $669 in tax you'd have to pay on that. So doing this wealth accumulation is going to add another $2,372 to your investment that you wouldn't be able to do with stocks because you have to keep the money in there the whole time. With this, you can decide to invest it in the money market account to get that 2%, or you can take it out. Choice is yours. But we're going to add this $2,372 to the sale proceeds after selling this commercial building after a 5-year time period, the cash flows after tax for 5 years, and this is 2% you would have received interest on over the 5 years in a money market account. When you add all those up, the grand total is $179,001. So when you take that and compare it to the Vanguard Mutual Fund, which is getting 8% average over 5 years, that return is $79,786. I'd do the commercial investment if I were you. Thank you everybody for watching. Don't forget to click the like button, subscribe. I'll be putting out content over investing basics, a couple videos a week, so stay tuned for more to come.